All right, ladies and gentlemen, welcome to MacroAce with your host, Tony. I'm also the head financial analyst at FinancialJuice as well. So, Bank of England, we've got about 30 minutes till the expected 25 base point hike. Funnily enough, at the same time as Bank of England interest rate, we have the Turkish weekly repo rate, where they're expected to, well, economists expect the Turkish central bank to hike by 1,150 basis point hike. 1,150 basis points. Not a joke. When I first saw it, I thought it was, but no, it's not a joke. Anyway, Bank of England is going to be a main focus as always. Let's get into it. So, what is the Bank of England rate? It's the rate that banks pay interest to. It's the rate that the central bank pays interest to commercial banks. And why is it important? Of course, whenever you raise a rate, it means the central bank is trying to slow down growth or make sure it doesn't get too out of hand. And that could be in any number of areas, in inflation, in maybe consumer spending, if there are too many, if there's consumer spending is strong, or maybe that there is strong employment figures. More or less, you could say, of course, that's going, not just wanting to keep GDP under control, but then there's a knock-on effect of inflation too, which naturally would go higher if the economy is doing quite well. So for a higher amount of high rates, that is a scenario. Low rates, the opposite. It's there to support or create growth within the economy. Usually within a currency pair. For currencies, it's whenever rates are raised, currencies see an appreciation. Overall, in the short term, the market reaction would be that if the rate is higher than expected, or if the monetary policy statement is more hawkish than expected, then that will lead to the currency seeing an appreciation. On the flip side, if we look at the stock market doesn't like high rates. Of course, that increases borrowing costs, makes it harder for those businesses to pay back any debt, for mortgages too. So if consumers are having to cut back on their spending, or having to put their money into paying off their mortgage instead, then of course that means businesses would get less, or it would mean that businesses receive less revenue for the products and for the goods and services that they provide to consumers. So for the stock market, raising rates isn't good generally. For the bond market though, for the yields, bond yields appreciate when rates are raised, or there is a higher than expected, or when there is a more of a hawkish surprise, hawkish rate statement than what traders were expecting. Again, in anticipation that the central bank will continue to raise rates, or continue to tighten monetary policy even further. And then, of course, with bond prices will head lower. Of course, if bond yields go higher, bond prices tend to go lower. But of course, it's a way to attract people to jump into the bond market from the government side to buy up government debt at a nice rate. And then, of course, the bond market also moves if there is the expectation for the central bank to raise rates. Of course, the short-term rates and the long-term, particularly the short-term rates compared to the long-term rates, are affected more compared to the longer-term rates. That goes within whenever any central bank raises or lowers rates. It's always the short-term rates that are most affected by interest rate hikes. Hello, everybody. Hello, Kareem. Patelioni says, Tony, are you there? Hello, Blue Label. Hello to you all. Good morning. Okay, so I already mentioned that point there about affecting banks. Now getting on to where is the economy at the moment? What is the central bank looking at, and how is this going to influence their decision? So the unemployment rate at 3.8% did tick lower from 3.9. Unemployment change, a measure of how many, it's just more or less, it's in the name. How many unemployed people have there been in the prior month? That was at minus 13.6k compared to 46.7k. And employment change, which has about a 2-month lag compared to the unemployment change data, came in stronger than expected. It was 250k compared to the prior 182k. It was also stronger than the forecast back then as well for the figure. Inflation unchanged at 8.7%, as said, the figure that we had yesterday, where it was expected to go to 8.4%. but it then it was stuck at 8.7%. So this is where, and we'll go through in a little bit later, where the expectation for the 50 basis point hike from the central bank emerged. And we'll go through in a bit more detail later on, but just something to kind of to note that inflation sticky, stuck at 8.7%. Core CPI was at 7.1% compared to 6.8%. Average weekly earnings year on year 6.5, higher than the prior of 5.8. Q1 GDP of 0.1% compared to Q4 0%. GDP year on year of 0.2% compared to the prior of 0.6%. Services PMI 55.2 compared to 55.9. Manufacturing PMI 47.1 compared to the prior 47.8. So, and then retail sales year on year came out at -3% compared to -3.1%. So one thing I think everyone is more or less focused on, and the central bank is focused on, is that inflation staying at 8.7%, not going down, might. And I think Patadino, hello, good morning, Lee. And Patadino says central bankers hate working class or middle class British people. I think you've got to include the government there too. But yeah, so the odds of a 50 basis point hike. So I'll kind of go through it a bit. Why not? I'll go through it now. The odds for a 50 basis point hike from the Bank of England was at 50% for this meeting, off of the back of inflation being sticky. Okay, and that was after about 30 minutes after the release had come out. About an hour later, that had gone down to 45% chance of a 50 basis point hike. What money markets were pricing in for the Bank of England to do at this upcoming meeting. So that's one thing to note, is that if money markets have started to think that, okay, the central bank might bump up and do a 50 basis point hike instead, then again, you would expect the Bank of England to be focused, keep its focus on inflation and try to bring down inflation and unglue itself from its sticky situation. Then if we look at the previous statements from May 11th, they delivered their biggest upward revision to GDP in MPC's history. They saw 0.25% GDP growth this year and 0.75% next year. New forecast contained no negative quarters, and they expect the UK economy to avoid a recession. And some of the previous rate statements that we'd seen, that they had expected the UK to go into recession, but now that they've removed that altogether, that's what caused the pound to see strengthening the last time around, but we'll go through the deviations too. The Bank of England is worried about inflation for food and core goods prices. Now, we've seen how the supermarkets raise their prices by quite a high amount, making it more difficult to buy the necessities that people need, like milk, bread. Hey, my tomato ketchup. Actually, the mayonnaise Hellmann's mayonnaise, I think. Hellmann's or Heinz, either one. It used to be around £1.50 or about £1, and now it's about £4.50, right? So super crazy with what the supermarkets are doing. Okay, the agent survey. Many companies aim to pass cost on to selling prices as much as they can, and we've already seen that from what the supermarkets have done. Then the comments from Bank of England's Governor Bailey and others. Bailey said we have a good reason to think CPI will fall sharply from April. That didn't happen. Not as sharply if you're thinking about from the last inflation figure that we had before the one yesterday, going from double digits into single digits. If that's what you're talking about, then it was right then, but not for the last report that we'd seen. So more or less upsetting or putting Bailey's thoughts or current thoughts about where the rate hiking path should be, what it should look like, just slightly off prediction, meaning that there is the odd of a 50 basis point hike that could happen if they do decide to be a bit more aggressive. So he also said that I see modest but positive growth, Bailey signaled Bank of England might pause rate hikes if UK inflation slows, and that was in an interview with Bloomberg. May 17th, Bailey also added that if there were to be evidence of more persistent pressures, then further tightening monetary policy would be required. So this is the sentiment at the moment from what we've seen from the Bank of England. It's unchanged. You still have. So just to explain this, this shows who lies on the hawkish and dovish side. Just a nice infographic image that was provided by Bloomberg as a way to just kind of show where does everyone lie on the scales. And you can see with Tenrera and Dingra, they have remained unchanged, and they did vote for no change at the last 3 or 4 meetings. Oh, possibly if I kind of bring it up here actually. So 5 meetings. That's 5 meetings in a row where they've said that they would want the rate to be unchanged. So so again, the likelihood of these two becoming more hawkish, not enough to go to the tightening phase, but to kind of shift over towards hawkish side. If that does happen, where there is, so the expectation is for a 7-2 vote in order to vote for a rate hike. Okay, then it splits up into who votes for a 50, who votes for a 25, who votes for no change, or who votes for a cut, and so on. So if you have Dinger and Tenrero that then opt to raise rates, and then the voting amount then the total votes becomes 9 who voted in favor for a hike, then that would provide some very hawkish sentiment from the Bank of England. If it's the same where they do a 7-2 vote where Dingra and Tenrero are looking to remain unchanged for the 6th time in a row compared to the other members of the central bank that want to raise rates, then that could muddy the waters and that could mean that the pound is open to bearish sentiment if 2 of the members are not understanding or being perceived as being able to understand that inflation is sticky within the UK. That's the key thing that they need to get down before they start thinking about how the economy is going to recover. So this is one thing, is that if that doesn't change, if it stays the same, you could see some bearish sentiment for the pound, or maybe the initial increase might not be that strong. Even if there is a 50 base point hike that's taken, it might mute that strength in the movement, potentially, if there isn't, if they're not all in favor for voting for a hike. So this is going to be quite a tricky one to kind of monitor and kind of, try to prepare yourself for. So hopefully that little bit helped you with that there. So investment bank and market views. So you had Citi, they expect from May 24th, they expect 2 further Bank of England rate hikes rather than 1, and no cut in November after inflation data. Bank of America anticipates the Bank of England to deliver a 25 basis point rate hike again in June, August, and September, and raise the terminal rates to 5.25%, get to their terminal peak rate of 5.25% versus their previous expectation of 4.75%, which is where they are at the moment. Credit Suisse, I expect the Bank of England to deliver 25 basis point hikes June and August, looking at the rate looking at the rate of 5%. May 26th, Barclays expecting the Bank of England to tighten beyond the June meeting, seeing an additional hike in August, and also expecting 5% as the terminal rate. And then June 21st, Toronto Dominion Bank, they said that rampant price pressures, this is post the CPI release that we had yesterday. They said the rampant price pressures in the UK may sway global central banks against downshift to easier policy, as according to Kumra, a senior rate strategist at Toronto Dominion Bank. So the key thing there is that, one, if we're going all the way back to a couple of weeks back to when the RBA surprised the markets and went with a 25, then the Bank of Canada surprised the markets with a 25 base point hike as well. if the central bank here decides to continue, maybe go with a bigger rate hike rather than maybe a 25, that could complicate the picture for other central banks around the world, particularly the Fed, if the view is that inflation in other areas of the world is not coming down as fast as other central banks might want it to be. Then again, you've got to think about the dollar's competitiveness. If the dollar becomes too expensive to trade and deal in, compared to other nations that might be struggling with a lower rate of interest or a cheaper rate, then sometimes you could experience as some businesses or investors could put their money or use their money, trade the money within, could use their money, or could buy other goods from other nations if it's too expensive to buy dollar denominated goods. That's one factor to consider too. But the central bank is thinking about where inflation is, and if they're near to the inflation target or near to inflation hiking, if they're near to their hiking goal, then it makes it more difficult to kind of say, well, maybe we need to continue raising rates, or maybe we just stay where we are. So that makes it a bit muddier. So again, if other central banks are raising rates, or continue to raise rates, and if they go past where the Federal Reserve is, if that does become the case, then again you've got to look at the competitiveness of the dollar as well, compared to other nations that have a smaller rate of interest and may have a higher rate of interest, and their currency becomes more valuable compared to the dollar. It doesn't mean you're going to lose dollar trading altogether. It just means you might see a slight shift in the currency here or there, but it's not really going to make much of a difference to its dominance anyway. Overall, in the global market, about 45% of global trading is done through, and I mean businesses or global transactions is done through the dollar worldwide. So the odds of that changing, not really, but it's just something to be. It's quite interesting to be aware of. Market pricing. So 11th of May. I think we'll kind of skip towards the end here. So again, when inflation did go to April, again it was a surprise. Although it did go lower to 8.7% from 10.1%. Traders expect the Bank of England key rate to be at 5.5%. On the June 13th, then you'd seen post the employment data again when it was stronger than expected. Peak rate jumped 0.12% to 5.7% by February, is where they expect the terminal rate to end up. And then later in the day, it went even higher, to expecting the rate to go to 5.75%, peak rate for the first time since October. So that just goes to show you how important looking at where the economy is at the moment is key to understand before you go into, hell yeah, I'm going to trade the Bank of England bank rate without knowing what the economy is saying. What is the central bank thinking themselves? So, and I'm sure most of you know that and understand that. June 21st, as said, post-sticky CPI report. Traders fully priced in 6% Bank of England rates by December after the CPI data. They see 50% chance of a half-point Bank of England rate hike on Thursday. So that was as of 30 minutes after the data came out, there was a 50% chance of what money markets were looking at. Then it dropped down to 45% chance of half-point Bank of England rate hike for today. So what does that mean? Well, it could mean that the initial reaction of the sticky inflation wasn't great, and that it means that the central bank will have to be more aggressive, and then it kind of petered out. It kind of slowed down a little bit, and traders kind of calmed down a little bit, and expecting there's less of a chance of a 50 basis point hike happening than it was 30 minutes post the release. Doesn't mean it's completely off the table if that's the case, but if the Bank of England instead decides to say that they're going to continue raising rates for longer, let's say past August, okay, if they want to raise, if they think that they need to stick with 25 basis point rate hikes, that could provide a mix of bullish sentiment or bearish sentiment. Bearish being that it's not a 50 basis point hike that markets might be looking out for or expecting, but it could be bullish in that the central bank is not going to be that aggressive with the monetary policy, i.e., being going in bigger steps, but they're going to continue raising rates for longer, like the Federal Reserve has done, and how they updated their forecast where they see the terminal rate or the Federal funds rate at 5.6% by the end of 2023. So that's the other scenario that could be presented for the Bank of England. So it's a mixy wixy day for the Bank of England. Somebody said, "Is there?" No, that there isn't a live link for the MPC meeting. No, that there never is. For if you're talking about them discussing it, no. It's sometimes there is a press conference after the rate decision has occurred, but not for this one today. So this is how the markets reacted. You can see cable, you can see that the pound flew up, and then the FTSE 100 had taken a hit here, again in anticipation of raising rates by a strong amount, by potentially 50, or because it was sticky. It didn't go below expectations. Okay, so this is the last release that we'd seen last time round on May 11th. We've got about 6 minutes, so kind of we'll be quick with it. So this is about 10 seconds before the last release that we'd seen. Okay. And we'll go through the deviations as well. But you'll see that the pound did strengthen off of the back of the data, and it was the statement that was provided as well. Mainly the statement that was provided that caused the pound to shift and go into a higher gear and strengthen with that bullish sentiment for the pound. The reason being, as said, the main reason being, if I bring up deviations here, we kind of skip ahead here. So that was the initial reaction. So the main reason why, as you can see here on the deviation, so the deviation shows you how the markets react to an economic release or releases, and how strong is the reaction. So we can see here, now the rate was as expected, but whenever we do have interest rates, I've always said this, we need to be aware of what the monetary policy statement says, or if there are any economic projections that are presented at the same time. We need to be aware of how what they say as well, in addition to the rate decision itself. Sometimes the rate decision itself is enough, but then you've got other factors too to weigh. Who voted for a hike and whether that was as expected, or who voted to remain unchanged, or who used to be someone who voted for no change but now is voting for a hike. These are all the factors that we've got to consider rather than just the figures. So the last time around, it was the Bank of England delivering biggest upward revision to GDP in MPC's history, more hawkish than expected, which led to sterling's strength. So that's one thing to consider. Again, hawkish expectation of one, if they say the inflation is too sticky or too high, that they need to do more work to bring inflation down, that there may be a need to continue raising rates further, i.e. hinting at maybe raising rates further past August. Okay, if the current expectation is for them to maybe get to August and then pause. Again, they more than likely won't say what the figure will be. They'll kind of hint at it through their wording, that the continuation of raising interest rates will be needed, rather than saying there is somewhat of a need or there may be a need to raise interest rates. If they say we need to continue raising rates, that's more aggressive than there may be a need or there's somewhat of a need to raise interest rates. Unless they go dovish and they say, if they remove the language altogether, saying that they don't need to, that they need to raise interest rates, that would be different. Bank of Canada did do that, but they kind of more or less, when they did that, they left it open. So they weren't providing any signals to what they were going to do to the markets at all. So it's now more or less of a unknown game of what could happen. So this is what so again, if we do get a higher than expected rate, paired with, if you do get a higher than expected rate, usually the pound would see an appreciation. But if the statement is dovish, or if one of the if there is still Dingra and if Dingra and Tenrero, the couple of Bank of England voters, decide to remain unchanged, then that could muddy the waters and dampen the strength of the pound on the initial reaction, or maybe for quite a while throughout the session. That is a possibility. But if they do vote in tandem together, if they all vote for a rate hike and they go with a 25, that could still be seen as bullish potentially, because that means Dinger and Tenrero have switched from going unchanged to saying, okay, maybe we do need to raise rates again. Okay, 1 minute till the release. Okay. So we got Turkey expected to do a 1,150 basis point hike. Who would have thought in my life, in my time of doing this, that I would see that happen? But hey, we do. But anyway, as I said, the focus will be on the Bank of England. All right. Okay, 10 seconds. Hike, 50 basis point hike, 50 basis point hike to 5%. That's higher than the expected 25 basis point hike. Okay, all right. Let's go through this detail here. So, okay. Okay. All right. Okay, so that's jumped there off the back of the 50 basis point hike. The vote still, so 7-2. So we'll see how much, if that moderates the expectation, moderates the pound's movement. Okay. All right. So a 50 base point hike, which remember, like I said, it was 50% yesterday, and then it went to 45%. But it happened because inflation is sticky. If the inflation print yesterday did, if it did go lower, then I'm sure we would have seen a 25 instead. But now we're just kind of stating the obvious here. So let's have a look at the market reactions. What did we see? So did GPJPY still see the strongest reaction? Okay, so that's okay. That was a big reaction. That's 87. You can basically call that 87 pips towards the upside. Let's see. Okay, let's get this here. So that is it for the rate decision. So GPU is a cable, about 58 pips there. Okay. Patly, I know you did call it, but yes, also yes, the expectation did grow as well. So yes, but you correcto mondo. Yeah. Actually, I do want to get the lira on this too. Let me see. Hold on. Let me see if I can get the lira. Aha. Okay, here we go. That is the lira. So weakened. Yeah, still weakened. It wasn't enough. It was not enough. We were 500 base points off with what the markets were expecting. So with the Turkish rate. Okay, so we'll look. Let's see what this is doing. Oh, no, that's the initial, and then let's see. Okay, that was there was a bit of a delay to the Turkish data in general, so that's where the market reaction occurred. Right, came out one pass compared to what? Hold on, no, it's nuts. Hold on. Jeez. Okay. Well, that's the first time I've seen that on a currency pair. I don't know if you guys have seen that happen on a currency pair. It's whoosh. Yeah, the statement from Sunak, to be honest, isn't really doing isn't really doing much. Isn't saying a great deal. All right, so let's get into this. All right, so there we go, and now it's done. The market reaction has happened, and woo, and that is done. So let's get into what Financial Juice is, okay, where we get the live data for macroeconomic news or global news all in one place. That is what Financial Juice is. So a live voice and text service that gives you up-to-date news of what's going on within within geopolitics in global news, and also telling you what's happening in the markets and why it's happening and why the markets are moving in that way. So we can see, so here you have your live voice feed on. Actually, if I just kind of you get the live voice feed here. Okay, real-time news or being up to date with what's going on in the world, what's going on in the markets, why the markets are moving in a certain way. You have your news feed here again with the text of the headlines that we say on the microphone being put out here, or extra bits of research or news articles. Again, your news feed is here, okay, with your headlines, and also data is being charted here as well. On the left-hand side, you have your economic calendar. Again, is also in real time as well, giving you an up-to-date. So again, that's also real time. Again, as a way to look at the economic releases for the day, is also super quick as well with the economic releases. So all of this live voice, text, and your economic data, real-time data, are all in one place. Gives you, as a particularly for day traders, a big advantage that the big institutions or investors have. They have access to a live voice and text service, so they can manage their risk, to capitalize on their risk, and then stay ahead of the game, stay ahead of the retail traders. Right? You never really see the retail traders taking a big win. Maybe with maybe with the whole Reddit stuff, with all those stocks that never really did so well. But even then, so majority of the time, you never really see retail traders take the big win against the big boys. So this is one of the tools that they have to mitigate that, is to make sure that they understand what's moving the markets. Okay, why is the pound shot up and then gone back down? Well, it could be because they raised rates by 50 basis points, but then not everyone was in favor of raising interest rates. Dingra and Tenrero, there was still a 7-2 split, rather than all in favor of a vote. I don't know why they're looking for the vote to remain unchanged. Okay, it's good to have views, but I don't agree with them keeping the rate unchanged. Anyways, so a live voice and text service. This is something that there's a pro version of Financial Juice, which is what you're looking at now here, where there is no delay to the website. There are no adverts that are played here or there. There are no advert banners. It's all live. No delays to the service that's provided to you guys, and you can sign up to the Financial Juice. You can sign up to Financial Juice Pro. Okay, if I just bring up the link here for you. All right. So if you haven't signed up to, if you don't have an account on Financial Juice, and you want to buy, you want to subscribe to the service, make sure you have an account first. Once you've got your account set up, you've got your login, and you've verified your account through your email, when that does come along, go back to the website. There'll be a button here that says Go Pro. Select the subscription that you want, and then once you've paid for it, go back to the site, log out, and then log back in. That will act as a verification. Say, hey, you are now pro, and you'll be able to see this beautiful site that we have here on this page. Now, that's totally down to you if you want to go pro. If you don't want to go pro, that's fine. It still can be useful, of course. Having real-time news, you get that edge over everyone else. With the delayed version or the live version, there's a delay across the site. Not a huge delay, but there is a delay to the site. There is also a delay, as said, delay to the voice as well. So that is a live version compared to the pro version. Pro, real time, no delays, all in one place. light all in one place, but you have adverts and a delay to the website as a whole. So that's the pro version. That's the pro version of FinancialJuice versus the light version. Now, the MacroAce mailing list, or the deviations, okay, or the deviations that are showing you here as to why the markets moved in a certain way. And again, you can use that as a way to kind of understand what the central bank could do in the future, and then how much that could affect the markets as well. This is completely free. Okay, so if you subscribe to the mailing list, what you get is the upcoming deviations for the economic for the week ahead. So this week it was just the Bank of England, so you receive the updated version of the deviations for the Bank of England rate decision. But you can see here there are quite a few other things that we kind of cover. Some of the releases we don't do anymore because the market reaction isn't as big or isn't as consistent, or the importance is kind of pushed to the wayside. So CPI is the big release that everyone is still focused on. It has lost some of its allure. You don't see as huge reactions as you would have done in the middle of last year for the CPI print in the US, but still quite important for other nations. For other nations as well, which is something that we want to build and work on, is to look at other sessions, look at their economic releases, and provide macro news for that as well. Okay, so this, again, let me kind of explain it. So if you do decide to sign up to the mailing list, in the mailing list, not only do you get the deviations for the economic releases for the week ahead that we will cover, but also the summary of the weekend news and the summary of what to expect in Asia, Europe, and the US sessions generally. It's not a big email. It's short and sharp, a couple of paragraphs here and there, just saying what to expect. The detail comes with me explaining explaining the economic releases in detail here in the live stream. So if you did like this video, don't forget to give it a like, share it, subscribe to the channel, get the word out there. Let's push MacroAce. Let's pump it. So that is, but yes, so as said, this is completely free with the deviations for the economic release. Let's do a little explain as to what you're looking at. Omar says, thanks, you seem like a cool guy. Hell yeah, I am. If you think I'm a cool guy, thank you. Ali Raza Ali says, I didn't receive the link or email since last live. Did you send me an email to tony@financialjuice.com, and I'll make sure that you've actually got your email subscribed to the main list. That's the email there. Yeah, have a little look at the send an email to me, and I'll try and get that sorted for you if you didn't get an email last time. Sometimes there'll be weeks where there are no economic releases, so what I'll do is just provide the sentiment or what to expect in each of the sessions for the week ahead. So also be prepared for that too. It's not going to be every week we're going to be covering an economic release, because there might not be anything to really cover worth covering. So let's go explain what the deviations mean here. So this is all on a 1 minute 1 minute candle, a 1 minute chart that we're looking at the economic releases. The initial market reaction shows you going to the wick of the candle, okay, to capture the full movement, and then the figure in brackets shows you the movement 10 minutes after the release. So if it doesn't have the word up or down before the figure, in the brackets before the figure, it means it's going in the same direction. So cable, it was up 44.5 pips. After about 10 minutes of trading, it was still up by 31.5 pips, or around that. Okay, so although it did claw back some of its, did lose some of its gains, or raise some of its gains, it was still up from the release, 37.5 pips. If it did say that, like here, let's say for example, actually let me find a good one. So if let's say if it did say 46.5 up, but then after 10 minutes of trading, it has swung back and it was down 10 pips from the release, then it would say 46.5 up and down 10 pips. Okay, same for the stock indexes, bonds that I look at, as well as the other currencies. Same principle applies to all of this, just to make it clear. If you do have any questions about it, and if you're still confused about it and want more clarification, as said, I've put my email there. Get in touch with me, and I will clarify it for you. And if that still doesn't work, then I'll think of something to make it easier somehow. All right, but yes, Kareem says, thanks, Tony, for doing those live events. No worries. Patrick says, yes, Tony, we all appreciate it. Thank you. Thank you guys a lot. Don't forget, as I said, if you like the video, if you find it useful, share it. Get the word out there. If you haven't, if you enjoy this content but you haven't shared it, what are you doing? Why? Come on, share it. Help us expand. Anyways, enough of that jibber jabber. Let's go back to the rest of the markets. What are the markets doing now? Okay, so interesting. Okay, that summarizes FinancialJuice. We've also got TICKSTRIKE, which I did try to open up, but it was running an update. But what is TICKSTRIKE? TICKSTRIKE allows you to listen to order flow within various different markets. That's within stocks, futures, currencies, crypto, ETFs and ETNs, and also your internals as well. Okay, so what does TICKSTRIKE do? In another way to simplify it, it lets you measure the strength of the buying and selling momentum within an asset or assets. Okay, if I did have it up here, I would have shown you. If I can, or if I can bring it, no, okay, I can't get that. I can't get to that now. But what I would have shown you is like a little ticker box, which would have had a number with a plus or minus sign. A plus sign means there's buying momentum, minus selling. There are different levels to the sensitivity. Number one is the most sensitive to market reactions. So whenever there's a little bit of buying and selling going on, it will pop off. As you increase the level to level 15, and you can chop and change it with a little dial, with a little slider, should I say, all the way to level 15, which is the least sensitive to market reactions. Only when there's a big amount of buying or selling momentum that occurs, only then will TICKSTRIKE give you an alert. I hope that kind of helps. I don't have a visual aid to show you the cool setup that I had for it. But this is the link for a 7-day free trial of TICKSTRIKE. Kareem says, "You're eating mango? Oh man, you better. Is it ripe or is it kind of like greenish? If it's green, I swear I'm gonna come around your house and I will. No, I don't think I say those words on here. No, yeah. It better be ripe. If it ain't ripe, it ain't right. Nah, it's the good stuff. Okay, good. All right, so that is FinancialJuice for the week. Next week, what I'll do, so every Monday I put out the MacroAce. I put out an email once a week, right? It's not an email every day. It's once a week that I provide you an email. So again, set your expectations. If you think there's going to be an email every day with videos or expectations, that doesn't happen. Keep it simple, and I will explain the rest. I always and it's best for me to explain the rest in live stream videos like this. But all right, ladies and gents, thank you very much for joining me live. Enjoy the rest of your day. Take care, and I will see you guys next time. Ciao.